Hey guys, this is your host Nitin Binhani and a very warm welcome to my startup podcast channel Audio, where we share real stories with real learnings.
In today's episode, we will dive deep into the failure of ZestMoney, a once promising buy now, pay later, or BNPL startup in India that saw a remarkable and rapid rise, but faced an equally dramatic fall. ZestMoney's story is a cautionary tale about the underlying risks lurking in high-growth fintech space, and beneath the initial success of ZestMoney were the key fundamental flaws that led to its failure. Let's cover this insightful story in different phases. 1. Launch of ZestMoney. ZestMoney was launched in 2015 with big dreams and substantial backing. It was founded by Lizzie Chapman, Priya Sharma, and Ashish Anantharaman, who believed in making credit access easier and more flexible. Their solution was Buy Now, Pay Later, or BNPL, letting consumers purchase products immediately and pay in installments, often without interest. It was a hit among young Indians, especially during the pandemic. But by the end of 2023, ZestMoney's story took a bleak turn. 2. The initial rise. To understand ZestMoney's collapse, let's first look at the factors that contributed to its initial rise. ZestMoney's timing was spot on. The economic downturn during the pandemic boosted the appeal of BNPL options, particularly for price-sensitive consumers. With support from major investors, ZestMoney expanded quickly. At its peak, ZestMoney had over 17 million users, 27 lending partners, and a network of 85,000 retail touchpoints, both online and offline, across India, thereby enabling the loan dispersals of 400 crore or $48 million per month. Funding coming to its fundraising, ZestMoney had raised around $125 million across 7 rounds, including debt financing. The September 2021 Series C round of $58 million valued ZestMoney at $435 million. The startup was backed by prominent investors like Australian BNPL Zipco, Goldman Sachs, Xiaomi, Quona Capital, Omidyar Network India, Flourish Ventures, and Scarlet Capital. Yet, the investors had to write off their investments owing to its shutdown. 4. Regulatory challenges. The Reserve Bank of India's tightening rules on digital lending came down hard on the BNPL sector. In June 2022, the RBI barred non-banking companies, including ZestMoney, from loading credit onto prepaid cards, a key aspect of their model. This regulatory shift caught many fintech firms off guard. US-based BNPL startup Sezzle too shut down its India operations. Subsequently, PayU shut down its BNPL card service LazyCard while announcing the company's financials in 2023. For ZestMoney, which heavily relied on BNPL, it was a major blow. It scrambled to adapt, but struggled to establish new partnerships with banks and NBFCs. And major lending partners began severing ties. Without these relationships, ZestMoney lost a crucial pipeline to fund their BNPL services, effectively stalling their operations. Since then, ZestMoney was looking for a buyer. 5. Financial mismanagement and rising losses. ZestMoney's financial troubles weren't solely due to regulations. Reports indicate the company's debt burden climbed significantly, driven by high operational costs and a substantial rise in loan defaults. At its worst, ZestMoney's non-performing assets, or NPAs, reached levels far above the industry's BNPL average, creating an environment where sustainable growth was nearly impossible. In fact, ZestMoney's financials tell a story of spiraling costs. Service deficiency charges, essentially the cost of bad loans, tripled in just 1 year, a clear signal that bad debt load was becoming unmanageable. And with customer acquisition costs hitting $1,000 or $12 per customer, it was clear ZestMoney was burning through a lot of cash. 6. Failed talks for an exit. In November 2022, the Walmart-backed fintech decacorn PhonePe was in talks to acquire ZestMoney, a move that would have marked the Unified Payments Interface (UPI) leader's foray into digital lending. As per reports, the deal size was pegged at around $200 to $300 million. But in March 2023, PhonePe walked away from the deal, citing issues with due diligence, leaving ZestMoney in chaos. Sources indicate the inflated revenue numbers, doctored customer acquisition costs, and high bad loan rates as the key issues. The failed deal was the defining moment in ZestMoney's decline. It laid off 20% of its workforce, roughly 100 employees, and soon after, all of its 3 co-founders exited the startup. The final nail in the coffin. With the PhonePe deal dead, lenders, including some big names like ICICI Bank, pulled their support, leaving ZestMoney stranded. Loan dispersals fell from a high of 600 crore, or $72 million, to just 200 crore, or $24 million. It was clear by now that ZestMoney's BNPL model, without consistent capital inflow and lending partnerships, couldn't sustain itself. In August, ZestMoney's existing investors pumped in funds of nearly $5 million to keep the business running, informing the remaining employees that its turnaround plan, dubbed ZestMoney 2.0, was ready and to be implemented by the new management. Alas, ZestMoney 2.0 never took off. In a town hall meeting on December 5, 2023, the new management told employees the ZestMoney was winding down and would lay off the remaining 130 employees, and a small team was retained to undertake the company's closing down process. In a surprising turn of events, while ZestMoney faced its demise, two of its co-founders went on to start a new venture called Swiffy Labs, a fintech platform backed by Geo Platforms. Their mission this time is to help financial institutions leverage AI to build new-age digital financial solutions. The founders cited it as a second chance, a way to apply the key lessons they learned from ZestMoney's turbulent journey. Key takeaways. So, here are the big takeaways from ZestMoney's failure. 1. BNPL can be an incredibly high-risk, high-reward sector. Regulatory uncertainty and dependency on external lending partners can expose companies to volatility. Fintech founders and investors need to be prepared for these regulatory shocks and should have backup plans for quick pivots. 2. Transparency and accurate reporting are non-negotiable, especially when acquisition talks are on the table. Inflating numbers may offer short-term gains, but it can backfire spectacularly, as we saw in the ZestMoney PhonePe deal. 3. A sustainable business model can't rely solely on customer acquisition without managing debt effectively. Rapid expansion is alluring, but as we see here, it needs to be underpinned by robust financial planning and rigorous checks or audits. So the shutdown of ZestMoney leaves behind an essential lesson for all of us in the startup ecosystem. Rapid growth is thrilling, but sustainable growth and transparency are the key factors that keeps a company afloat. Thanks for tuning in. If you enjoyed today's episode, please like, subscribe to our channel, and share with your friends.
And with this, we have reached at the end of this podcast. Thanks for your valuable time, and please like, comment, and share.